Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's a mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call Mom.
I'm Vera Nelson, broker-owner of Hyde Realty. Hyde Realty is a boutique agency located in Southern California, dedicated to our clients. We cover all of Los Angeles, Orange, Riverside, San Bernardino, San Diego, Ventura, and Kern counties. Whether you're looking to purchase your first home or sell your last, my team and I are here to help you. With years of experience representing active service members and veterans, we have the tools to get your offer accepted. We work hand in hand with first-time buyers to help them achieve their goal of ownership. We represent the savviest of buyers and sellers, from investors to probate and multi-million-dollar transactions. The Hive team is ready to help and serve you with the knowledge and experience you deserve. Please reach out today if you would like to discuss your needs and how we can serve you. Once again, I'm Vera, broker-owner of Hyde Realty, 626-298-3025. Vera at Hyde, Hythe, Realty, REALTY.com.
All right, so welcome to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom, and every week I'm bringing you guys new topics and subjects to discuss what is going on in real estate. Where are we at within the year, right? So right now we're going to talk today about getting yourself ready if you're planning to buy in 2025. We are at the end of 2024. And what does that mean? Well, right now we are in the slow season. The slow season is awesome because you can get a much better deal when properties are listed for sale and maybe offers aren't coming in on those properties. So those sellers will actually start to give you a little bit better price, or possibly pay closing costs. You'll usually get a little bit better deal. Well, that's going to actually continue to move past the holiday season and all the way into about March. Now, March of 2025 is when things are going to start to ramp up. April, they're going to start to get a little busier. May, they're going to start to be bustling. June, July, and August are the absolute craziest months. And that is historically within the real estate world, because most people don't want to buy during the holidays. Then they say, I'm going to do it next year. Let's just get through the holidays. Well, then they've got kids in school and they don't want to be trying to get the home listed for sale and dropping kids off to school and just going crazy. So in general, most people want to do their purchasing and they're selling, listing their homes in those early summer, late spring months, because they don't want to move their kids' school in the middle of the school year. They just want to get through that year, right? But they might start to put those homes on the market in April, thinking that the property will probably sell in May, close in June, and the kids would be out of school. So we're going to see late spring is when things are really going to start bustling. Right now, as I mentioned, I am starting to see some people get some really fabulous deals. We have a client right now who is selling their home. They've got the property listed for sale. They've been on the market for a couple of months. They just got 2 offers in on the home. It always seems to work that way. It could be something that's sitting for a couple of months and then all of a sudden, boom, boom, there's multiple offers. But those buyers are actually offering $40,000 and $50,000 below the listing price, and the seller is contemplating accepting that. So we are seeing people right now in this time frame getting some really good deals. So I want to make sure that we get you guys set up, prepared, and ready for the buying. The best time to buy would be right now through about May of next year. And if your plan is to buy in 2025, we want to get you prepared and get you going, get that pre-approval started so that we can get you there while there's a lot less competition out on the street. So that is what today's show is going to be about. We're going to talk about getting you guys prepared. What should you be doing? I want to remind everybody that this is interactive. You are more than welcome to put your questions into the feed. I'm more than happy to read those out loud and answer them for you. I can see, as always, my dad has jumped on to say hi. So, Dad, thank you so much for joining. And I did want to show off my really cool sweatshirt that I am wearing. As I have said in multiple episodes, my son is autistic. And so this is, I'm going to kind of stand up so you guys can see it. This is my Mama Bear autism sweatshirt. So I wanted to show that off today. I was very excited when it came in the mail. But other than that, I do want to get you guys prepared and ready for our home buying season. So let's start talking about the first place I want to start is, the first question is going to be is what kind of credit do I have to qualify for a loan? So I want to start there with credit because that is one of the things, again, if your goal is to purchase in 2025, it would be a great time right now to start working on getting that credit score as high as possible. We can do credit scores very low. We don't necessarily have to have the very, very best of credit scores. However, the higher that the credit score is, the better that the interest rate will be that you will get. But we can do loans. We've done them before, all the way down as low as 550, I would say would be the minimum credit score that I've actually seen get approved. There are programs that say that it could be lower than that, but I've actually never seen them come to fruition. So I would say to be safe, 550 would be the minimum credit score. So you might be looking, listening to this and saying, oh gosh, okay, I didn't think that I could do that. Now I'm going to mention again, the higher that the credit score is, the better that the interest rate will be. So if you have a 550 credit score, do not think that the interest rate that you are going to get is something that you happen to randomly Google, what are interest rates today? That is not going to be the interest rate that you are going to get. Your interest rate will be elevated based on risk, which is your lower credit score. Now we start to see interest rates get significantly better. So there is a pretty big jar to where the interest rate is that you're offered between 550 and 600. So when we get to 600 and above, then we start getting into more normalcy. Now, of course, if you have a 600, you're going to get a higher interest rate than if you had a 700. So once again, we want to try to get you guys thinking about what can you do to get your credit score as high as possible, because it is going to help you with getting into a better interest rate, in turn helping that monthly payment. I can see that it looks like Ronnie Nava got on and said hello. So Ronnie, thank you so much for joining. And again, you guys, this is interactive. So if I say something that you have questions about, or even if you have a question and I'm not talking about it, please feel free to put that into the feed. It is absolutely fine. I'm going to read it out loud. If you have the thought, if you are thinking it and you have the question, by you asking the question, you are going to help everybody else that is watching now while I'm doing this live and who go back and view it later. Maybe they're at work and they can't jump on. But if you have the question, the chances of somebody else having that same question is very high percentage. So please go ahead and put that into the feed. So once again, where can we go with credit score? I would say lowest about 550 is what I've actually seen us be able to get through. Now, how much do you need for a down payment? Down payments are going to be based on you, your credit score, what you do for work, what type of loan are we offering to you? So let's just say, let's go back, kind of to basics. You're a W-2 employee. You have a 580 credit score. And you can fully income qualify for the loan. You're not self-employed where you're writing things off. Don't want to show us tax returns, right? So if we're getting W-2s and pay stubs and you're in that lower credit score bracket, your minimum down payment is going to be 0 if you're a veteran, or 3.5% down going with an FHA loan. Now, if your credit score is above 620, then we start looking at 3% down which we could move to instead of 3.5 on a conventional loan. Now, many times we won't go that route because the FHA loan has a better interest rate than a conventional loan does. Now, if you've got a super high credit score and a larger down payment, then obviously conventional is probably the better route. But when we're talking low down payment and lower credit scores, FHA typically seems to be a better mortgage insurance payment, and it seems to be a lower interest rate. So a lot of times we'll still keep you in that FHA loan with that 3.5% down. Now, we've got down payment assistance, right? So if you're not a veteran who gets to take advantage of a 0 down payment loan, we do have down payment assistance programs. But I do want to make sure that you're aware of how down payment assistance works, because it's not necessarily for everyone. And before I take off into that route, I can see Why Not gets on it, says, happy holidays and happy Wednesday, everyone. Heather jumped on and said, what if I have collections or charge-offs on my credit report? Can I still buy a home? So that's a great question, actually. And the answer is yes. So you can have collections, you can have charge-offs, you can still purchase a home. One thing to keep in mind, in general, every single loan program is slightly different, but in general, the majority of loan programs, if it is in collection, they are going to either make you be on a payment plan to get the debt paid back off, and we have to qualify you with that minimum monthly payment, or if it is, or you have to pay it off. So one of the two, right? If it's a collection. If it is a charge-off, we do not necessarily have to do anything with it. Typically, charge-offs we can ignore as though they don't exist. We're already working your financing into what your credit score is based on your interest rate. Collections are considered not recoverable. So there is a difference between charge-offs and collections, but it does not keep you from being able to purchase a home. So please don't think, oh, I've got a collection, I just can't do it right now. You actually can. There is a way to do it. Ronnie says, what if you don't have money for a down payment? So that's where we're going to go into the down payment assistance. So I think that is important for us to touch on. And that is what I started right before Heather and Why Not had commented. So with down payment assistance, number one, you have to be a first-time buyer. What is considered a first-time? With most programs, there are a few down payment assistance programs out there that do not require you to be a first-time buyer, but there are not very many. So again, I'm going to go with the general rule of thumb for today's episode. Let's just go with you need to be a first-time buyer, because those are the biggest down payment assistance programs will require that. So if you are a first-time buyer, what is a first-time buyer? A first-time buyer is somebody who has not held title to a property, real property, so real estate, in the last 3 years. So if you owned a home and you sold it and you then went and you rented, and you've been renting for 3 years since you sold your property, you are once again now considered a first-time buyer. If you've never purchased a home before, of course, you are a first-time buyer. So you need to be a first-time buyer. Number two, you need to typically, again, we're going to go with general rule of thumb. We do have programs that will let you have a little bit lower credit score, but the majority of the down payment assistance programs want you to be at a minimum of 640 on that credit score. So that is why I said if you have a 580 or you have a 550 or you have a 620, you are going to have to come up with some down payment. Now, if you have a 640 or above, we can easily, and you're a first-time buyer, we can easily find you a down payment assistance program that would help to supplement the down payment that you do not have. So that is definitely an opportunity. Now, one thing that I do want to mention is that if you qualify, and this I'm just going to throw out general numbers so that you can grab the concept. So let's just say that you qualify if you have a down payment for $400,000 in your loan amount. The majority of the time, you are only going to qualify for about $300 to $320 using down payment assistance. So I'm going to kind of explain why. I'm going to explain why that is. Why is there such a big differential in how much that you will qualify for between utilizing down payment assistance or coming up with that minimum down payment that is required. But before I do that, I can see that I've got some comments coming in. So Why Not says, I have good credit, but am considering a small personal loan to consolidate my credit card debt. How will that affect a home loan? To bring up my credit score even more. So Why Not? It actually isn't going to affect how much that you will qualify for in a new home loan. You will be just fine if you were to take a personal loan to pay off your debts. It will increase your credit score because when you pay off credit card debt, you're opening up the available line of credit that you have. And that looks better to the credit scores when you've got a lot of open availability versus being very maxed out. Those credit cards have minimum monthly payments right now. That new personal loan is going to have a monthly payment. So we are going to qualify you with that personal loans payments because your credit cards are obviously going to now be at zero. So the only thing that is very important for you to keep in mind when you are deciding on signing for that personal loan is how much are my minimum monthly payments right now on my credit cards. So go through those statements and add up what the minimum due each month is. And then how much will this new debt consolidation loan be on a monthly basis? So if those minimum credit card payments are lower than what the new payment will be on the consolidation loan, now we've got a higher monthly payment that we are going to be qualifying you with in your debt ratios versus maybe the lower payment that those minimum credit cards were giving you. Now, obviously, the minimum payments are never going to get those credit cards paid off ever. The consolidation loan will get those cards paid off. So consolidation loans, in my opinion, are never a bad thing. But that would be the only downside would be if the minimums are less than what the new monthly payment would be on the consolidation loan. But you are right. It absolutely will increase that credit score. So before I went into those items, I said I wanted to explain why with down payment assistance, you might qualify for $400,000 if you had a down payment versus maybe qualifying for $300,000 or $320,000 if you utilize the down payment assistance program. So I am going to take a super quick break. We're going to run a fast commercial so I can grab some water, and then we're going to jump right into that. So stay tuned. Oh, is it time to go for a ride? Hold, please. Let me grab a few Road Sodies to go. Our newest collection, Road Sodies, is a tribute to all of those die-hard passengers enjoying the dunes and mud while the captain does all the work. We have tees, hoodies, and hats to help you show off your style. This design just launched. Be the first to grab yours today and show up to your next adventure in style. RVRmoms.com. All right, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom. And right before that super quick break from River Moms, which I have got to advertise, that is my son's company. He's coming out with some of the cutest designs. If you guys like to go riding in the desert, hitting the mud, if you guys like to go boating, and you are just a fan of doing all of that outdoor activity, he has got some fabulous designs for you guys. So go to River Moms, which is RVRmoms.com. and check out all of his new designs. He's got great ones for the winter right now. I would say my favorite of all of his designs is the Passenger Princess Club. So that is for anybody that is going to sit shotgun when they take a ride, in a side-by-side and go have fun through the dunes or through the mud, going out maybe to Cal City and to go riding. But he's got tons of great stuff on there, bonfires and beers and all kinds of fabulous designs. So go check it out. All right, so back to down payment assistance. Why would you qualify for less if you utilize down payment assistance? So with the down payment assistance, they put what are called overlays over the top of the program. So what debt ratio is allowed? When we do down payment assistance, we are typically using either FHA or a conventional type of loan. Those are the loan programs that are allowed to be utilized with the down payment assistance that goes on top. Now, those programs are going to give us particular debt ratios that we can qualify you to. So let's just say that the FHA program, for example, we can go to a 56% back-end debt ratio. Back-end debt ratio is all of your debt. So that minimum monthly payment on that debt consolidation loan of why not? If you have minimum credit card payments, if you have a student loan payment, if you have a car payment, we're going to take all of your monthly payments. We're going to add the new mortgage payment that we're setting up for you. And all of that debt combined cannot be more than 56% of your gross income. So gross would be before taxes are taken out of your check, what you are making gross. That is for an FHA loan, for an example. Now, when we utilize down payment assistance, because you are not putting any of your own skin in the game, you did not have to come up with money to get into this property, they are going to limit that debt ratio to 45%. So think about what a big difference that it is, 56% overall debt ratio to 45% debt ratio. So it is a very, very big difference how much that you will actually qualify for in loan size. So I have many clients that will ask me, well, if I can't scrape together the money, can I get a gift? So number one, absolutely. You can always get a gift. And believe it or not, you can get a gift from family. You can get a gift from friends. You can get a gift from an employer. So yes, you can absolutely get a gift to help you with the down payment, which would then help us to not have to go with a down payment assistance program. Now, those down payment assistance programs, again, this is general, not every program, but on general, the overall majority of those programs, they do have a higher interest rate than the interest rate that you are going to get if we just do a regular loan with your own down payment. Your own down payment, it is considered your own down payment, even if you get a gift. So you're going to get a little bit better interest rate if you can come up with the money, and you are going to qualify for more if you can come up with the money. Now, I also get the question of, well, what about my 401k or what about my retirement? Could I take money out of that for the down payment? Yes, you can. Now, I'm going to tell you, yes, you can, because that is a guideline that we are allowed to utilize those funds. And here's the big if you can get your hands on the money. So you have to check with your 401k plan or with your IRA to determine if you can get the money out of your account. Again, generally speaking, most 401ks, most retirement accounts, they will allow you to pull money out of your balance if it is for the purpose of a primary residence purchase. Now, you are going to get taxed on the money because you are taking it before your retirement age. You are taking it before the tax deferral age that's allowed. So you are going to get penalized on that. You're going to pay taxes and pay a penalty if you do a base withdrawal. So what I always tell my clients is the first thing that you want to look at is, can you take a loan? It is much, much better to take a loan against your 401k plan or whatever employee retirement plan that they have for you where you work. But it is always better if you can to take a loan against it. When you take a loan against it, the monthly payment will be withdrawn directly from your paycheck. There are no taxes, so you are not going to pay penalties, and you are not going to pay taxes to the IRS for having pulled the money out early. And you are keeping your money within your account, so it's still working for you, and you are paying your own self back. So you do want to always try to go with the loan option first before going down the road of an actual straight withdrawal. But that is allowed to be used and utilized as well when purchasing a home for the down payment. So if you can scrape together the funds on your own of 3 to 3.5% down, much better choice. If you can't, we absolutely have down payment assistance programs available. We'll talk to you. We'll go through your income. We'll tell you what your maximum is that you will qualify for utilizing that down payment assistance, or how much will you qualify for if you do not utilize it. So that way too, you're seeing your options. What can or can I not do? Now, another thing that I'm going to touch on is buying a home and you have a home to sell. So I know that is something else that comes up quite a bit. We've got plans. We want to move into another property. We have a home right now. We're not sure if we want to sell it. We'd really like to hold on to it. The interest rate that we have on our current mortgage is great. We could rent it out for what we owe monthly. it would be really good to start a portfolio. I think that those clients are also very important to talk to because I think many of you believe that you have to have a really large down payment to go and buy a second piece of real estate. And that is absolutely not the fact. Okay, so Why Not says, can a credit card cash advance be utilized for a down payment? That is great. Great question. And no, it cannot be. So the money that you use for your down payment needs to be considered seasoned. Seasoned would be, I get 2 bank statements from you, and on both of those bank statements, that money has been in that account with no large deposit coming in. So that is number one, what is seasoned money? So if you were trying to pull money off of a credit card to utilize for your down payment, you need to start thinking way, way, way in advance. You need to pull that money, you need to get it deposited, and you need to let that money sit there and season in that account so that we don't know that you did it. All we can see as a lender is we pull credit, we see a balance on a credit card, we see a minimum monthly payment that you owe to that credit card. We're qualifying you in your monthly payment, and then we see your bank statements and we can see whether or not you've had large deposits or you have not. So obviously, if we can't see the large deposits, we don't know that you took it from a credit card. But if it's something that you want to do in the middle of the transaction, no, a credit card would not be allowed. Now, what else would be seasoned before we jump into the person that wants to buy a house that already owns a property? So what else would be considered seasoned? So if you sell a home and you're getting cash proceeds from the sale, that's seasoned money. If you're getting an IRS, oh gosh, Mikey, I'm spacing. What's it called? Refund. Thank you. I was spacing. If you get an IRS refund from filing your tax returns, that is seasoned. So it if you sell something, if you own a car and you own it outright and you sell it, we can see the all of the agreements and the title and everything transferred, then that would be considered seasoned money. So if you're selling something that you own, that is something that you've had ownership interest in, it was yours and you sell it, that can be a large deposit in your bank account. We just have to follow up with the evidence of what was it, where did that deposit come from? So that would be considered seasoned. Again, guys, keep the questions coming. I absolutely love it. Even if I'm moving on to the next topic and something else comes to mind that you want to ask, this is an interactive show. Please feel free to do so. I can see that Aurelio jumped on and says, hi, Debbie. So Aurelio, so great to see you on here. Aurelio is one of the best contractors that you guys can find in Southern California. He really is fabulous. He remodeled 2 of my homes, one of my mother's homes, and did some work at one of my sister's homes. And my mother-in-law. He also did the remodel of my mother-in-law's house. Just absolutely, absolutely amazing. I cannot even tell you how great that his workmanship is. If you guys would like Aurelio's phone number, please reach out after the show. I'd be happy to give it to you. Aurelio, please feel free to throw that into the feed for people to have your number to call you if they've got any work that they need done to their property. But Aurelio, so great to see you. And then Why Not says, what about investment dividends? Yes, of course. If you own even Bitcoin or any kind of stock and you sell it, we just have to be able to trace where the money came from, and that is considered seasoned. So absolutely, that would not be a problem at all. Okay, so moving into the person that owns a house today, they've got a great interest rate on their mortgage. They don't want to sell the property if they don't have to. They would like to try to figure out if they can buy another home and possibly hold on to the property and rent it out to start their real estate portfolio. So number one, a lot of people have the misconception that you need to have 20% down payment or more if you're going to buy a second piece of real estate. No, you do not. That is absolutely false. It is not necessary. You do not have to have a huge down payment to go buy a new property if you already own something else. Now, where that's going to change, draw the line, is what are you buying the property for? If you are buying the next property because you plan to live in it, you want to buy it as your new owner-occupied residence and rent out the property that you are departing, you can absolutely get into that next property with either 3.5% down with an FHA or 5% down with a conventional loan. So why would we pick one over the other? If you have an FHA loan currently and you are not relocating at least 100 miles from your current location, you can only have one FHA loan at any given time. If you need the rental income from the property that you are leaving to offset the debt to help you qualify, so you do not make enough money to carry both mortgage payments, then we're going to go with conventional as well, because FHA is not going to let us utilize that rental income on your departing residence. However, 3.5% down is better than 5% down. So if you don't need the rental income and you want the lower down payment, fabulous, and you don't already have an FHA loan. So you can see how talking to us, giving us your scenario, finding out what your goals and your plans are is going to help us to provide you with what options are available. If you have a lot of equity in your home and you don't necessarily have the 5% down to go buy that second property for your owner occupied, you've probably got equity in your home that we could pull a home equity line of credit. We can take money from one, which is going to be considered seasoned because you own it. It's your money. It's your equity. And we can use that equity line of credit as the down payment on the next property. So there are absolutely ways to get you into the next home with not a whole lot of money out of pocket, get you moving, get your portfolio started, and get your property rented out that you still own today. However, if we look at debt ratios and you just won't qualify to carry both, then unfortunately, sometimes that is the situation and you need to sell. But you don't know what your options are until you let us look at your file to see what is it that we can do. How can we make this work? There are tons of ways to make things work. Okay, so Joe Vera jumps on and says, howdy, y'all. Love your show, Debbie. So Joe's so great to see ya. Bryce Cooley gets on and says, I became a millionaire at 35. The question is how did I do it? I'll tell you how. So I absolutely love it when we get spam in our comments during our shows. Don't we just love these guys named Bryce Cooley? They're just amazing. Anyway, so we're going to move on from him. But again, I want to remind you guys, this is interactive. Please feel free to ask your questions. Throw them into the feed. As long as you're not Bryce Cooley, you've been banned. But please throw them into the feed. I'd be happy to read them out loud and answer them for you. Again, we want to get you guys ready for 2025. We want to get you moving before April to May of 2025. Right now is when the market is cool. This is going to be year after year after year. We are always slower from September, slowest in December and January. And then we start to pick up slowly and we truly start to ramp up in April. And then we go through our crazy buying season. And that buying season is going to come with more listings, but it's also going to come with more transactions. People that are listing are also buying. You've got more competition in the market. And the sellers don't necessarily have to help or possibly negotiate or even come down on price the way that they would if it was necessary for them to get a home sold during the slower months like right now. So if your goal is to buy in 2025, I would highly suggest that we are getting started now. We are getting your application put together. We are reviewing the options. We are talking about your credit. We are talking about how much money that you need. We are talking about, getting you pre-approved. And then you have got that certificate in hand and you are ready to go shop. And when you find the right deal, you can jump on it and you can make that offer as fast as you want to. Now, here's what's even better. If we pull your credit report for a pre-approval, that credit report is good for 4 months. So let's say that we start that pre-approval January 1. You've got, January, February, March, April, May. So you've basically got until April 30th, let's call it, before we would have to re-pull your credit again. So we can get you approved in January. You could work on your credit report that we say, hey, why don't you do this, this, and this to get your credit score up higher? You could work on that credit report through January. In February, even early March, we might see you reaping the rewards of what we told you to do with a better credit score. Beginning of March, you write an offer on a property and we close beginning of April and we pulled one credit report, just one. So I cannot push you guys enough. If 2025 is your goal to buy, right now is when it's time to get started. Right now is when it is time to book an appointment, get a phone call, work with us. And let's see what we can or cannot do for you. You guys can always go to my website. There is a contact us button right there. You can send me a direct email. More than happy to start the conversation in that direction. And then we'll move it forward from there if that's most comfortable for you. You can book an appointment right on the website for a phone call with me. So you go to the website and it's book appointment. It's a button, and go ahead and book that appointment. Whatever is the easiest way for you to get started is what we need to do right now. So we need to get you guys on the moving forward in the right direction, and we need to get you into the market as early as we can in 2025 before we hit that buying season. Remember also that we are absolutely expecting that interest rates are most likely, and I have to say most likely because obviously there's no crystal ball. There is nobody that can tell us 100% for sure that it is going to happen. So if I told you we are going to get lower interest rates in 2025, I could get into trouble for that. So we are most likely going to have lower interest rates in 2025. With lower interest rates, it is going to stir up a big commotion of a lot of people who have been waiting to purchase homes, waiting for those interest rates to come down. And you are not only going to be competing with the people that need to sell and move, you are also going to be competing with a lot of people that have been sitting on the market and literally waiting during this time that we've had these super high interest rates. So with that, I'm going to close up the show. Next week is going to be my last show of the year. So we are going to talk next week about the Fed. The Fed is going to be making their next announcement. Did they drop interest rates further? Are they leaving them the same? I will be able to give you a read on where our interest rates as of that day. So depending on what the investors, how investors are feeling. Today we had core PCE. Tomorrow we're going to have, we had CPI. Tomorrow's core PCE. I don't know. I'm in the studio right now, so I'm kind of getting, I'm probably turning things around. But anyway, we've had some inflation readings today. We're going to have more inflation readings tomorrow. And I will be able to give you guys a very good read on where are the rate sheets, how are investors reacting to whether or not they think that the Fed will cut, and then what happens immediately following the Fed's decision. So next week will be the final show of 2025. And then I'll be back, obviously, in January. But I want to make sure that you guys, are getting yourselves prepared. So we'll do that next week. We'll talk about where things are headed. And then we want you guys to jump in and take these last couple weeks of the year to truly plan out 2025 and to get those plans started. How do you call us? 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. Again, the website is mortgagemomradio.com. Do not forget the radio. Text me, send me a message, email me. I don't care what you guys do to get in touch, but start the conversation in a way that is most comfortable for you, and then we'll pick it up from there. I hope you guys all have a fabulous rest of your Wednesday, and I'll be back next week. Talk to y'all real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.